And it's time to take a look here at your weekly commodity market recap with Darrell Holaday of Country Futures. I'm Clay Patton, joining Darrell now here on the Rural Radio Network. Darrell, coming into the close, corn and soybeans higher while the cattle market has to claw their way back, but at least gets close to unchanged. What did you make on the week's trade?
Well, it was an interesting week. When you look at what went on in the cattle side of things, very interesting. A lot of panic selling early in the week in the cattle futures. I guess I want to start out this week with a big picture item that I think is really important to understand what as best I can on the macroeconomic side. We have to understand there's been a lot of money come out of all the ag commodity markets from a fund standpoint or a outside speculator or just money flow. When we talk about money flow, sometimes it's just a standard name. What do we mean by, well, there's just not a lot of outside money coming in on the speculative side. Both, you could say long or short, but definitely you also got to, definitely not as an investment side on the long side. That's just not there. And part of the reason is we've seen these bond rates get high enough, 5 to 6%, both public bond marks, corporate bond rates, high enough that they, with the uncertainty in the Middle East, they just all went to there's a lot of that money saying, I want out of stocks, I want out of commodities, and I want to get in something that's lowers the risk or is almost considered risk-free. So that, and then the reason that's important is because that's where they're going, yet at the same time, there's so much public debt. These federal governments have got record debts, including the U.S., so there's bonds offered all the time, and that continues to push the bond prices down and yields higher. Why is this important? The reason is when is this really going to end? Because when you consider this in the past, the Feds have been, 2.5 years ago, the Fed was always there. That's fine. We'll buy these securities. We'll buy these assets because we're increasing money supply. But they're in the process of lowering the monetary supply. For example, the M2 is down 5% since its peak 18 months ago. So they're not there to backstop this. And therefore, then the point of this is the Fed was probably going to have very little impact on interest rates. What the Fed does with the discount rate is no longer really an issue. It is more, it's the markets determinant, and right now the market is pulling itself out of those items and moving into bonds, partly because of the uncertainty and lots of factors, not the least of which the Middle East and just the overall debt situation that we see across a lot of governments. Now, on the grain side, how does this affect? Once again, grain and livestock, a lot of that is you've lost the fund money, so you're really just going to have to move off the cash side. Cash values in wheat for wheat in Europe continue to slack lower. Russian wheat production was raised up to 93 million tons. Their official numbers, certainly a lot of questions about that, but it's certainly above USDA's 85 million tons. It looks to us like that. We did see the energy market get weaker this week. That pressured the soybean oil and the corn, partly because the IDF or Israel held off going into Gaza. Of course, that has changed. We go into the weekend and we saw a little bounce in the oil late in the week. I think the pressure in the corn also, because improved U.S. yields are still, I think there's anecdotal evidence that indicates I just don't see us going much below 173 on the yield. And I personally think we could go back up to 4.5 or 5, and there's still a lot of corn to harvest, a little weather break this week at times, but it's still a lot to go. We've got kind of a squeeze in the soybean meal. The best story in the soybeans is not the export side of things. It's the good demand domestically. Crush margins are very good. Crushers need the beans as they push the bean basis. The export numbers are not very exciting at all. Matter of fact, our total commitments on beans out of the United States are down 29% versus a year ago, and actually they're the worst since 2018 and 19. And those of us who have any memory at all remember that was the trade war with China that year. So the bottom line is what we're missing is the recent is China business as a whole. There's others too. A lot of that business that we expected. We were disappointed in the November bookings. And so far December bookings have been slow, and China's just simply pushing a lot of that business to Brazil because their crush margins aren't very good. So, and Brazil's offering it at a discount. So our window to book the November businesses went away. Now we're working on December, and it just as I said, the pace is well behind a year ago, but the domestic business is very strong, and that's what's supporting this market and keeping it from falling apart as we were under a lot of pressure early this week. December corn down 14 on the week at 481. March corn down 13, closing at 495. November beans 12.97 down 2. March soybeans were actually up 2 at 13.33, but that's after being down early in the week. Beans did recover. December Kansas City wheat down 27 at 6.43. New crop November 18 lower at 6.70. December crude oil down 2.54, 85.54. Did dip down to the $83 level before rallying late in the back half of the session on Friday. On the livestock, as we mentioned, that whole issue, the panic selling early in the week in the cattle futures. Again, a lot of this with lack of fund money coming in, I think it has created some panic selling in cattle producers after the cattle on feed report on Friday, which really wasn't that big of a deal. But boy, it sure sparked another round of selling Monday. And matter of fact, February cattle were lock limit down on Monday. What we've done this week in the last 2 weeks is we've just pulled the premium out of the market in the cattle futures, and that really ties into what I started with in the macroeconomic side. You don't have the funds that are really the investment money that's thinks that's a good buy, so let's buy them because they're going higher. It's going to be the cash that's going to have to lead this market higher, and sure enough, that's exactly what happened this week. All the talk about lower futures, and we had the lower futures, but in the end, we ended up with cash, for example, in the South, $1 higher on the week at 185. North is going to be somewhat maybe a little bit lower to a little bit higher. It depends on what region you're at and where we end up with not all the business done. But the reality is that we still have very tight fed cattle supplies. The reason fed cattle slaughter is lower and the marketing number was lower in September is the cattle just aren't there. Packers have had some decent margins. They're able to move the beef. They're going to see the seasonal increase in values. And so no matter what the cattle on feed numbers say or reported, and I'm not saying the numbers are wrong. Cattle on feed numbers are just what they are. You don't know when they were placed. You don't know. We might know some weight ranges for the 100 pounds, but what cattle are there at different times are depend on a lot of different factors, and the number placed in any given month doesn't tell the whole story, and certainly the marketings don't either. Hogs were higher on the week. They set seasonal. I think they set the seasonal lows really last week. As in the future side, cash index continues to come down, but once again, that we've talked a lot that we think they had overstated the weakness that we're going to see in the index for the seasonal low. With that December hog contract around $66, we rallied back up above 70, and I really wouldn't be surprised if the December contract ends up around 72 when we get to the low on the index. On the week, October cattle down 27 cents at 184. December cattle down 240 at 182.22. That's after being down at one time over $7 on the week. November feeders down 532 at 236.90. January feeders 740 lower at 235.70. Once again, you take the premium out of the market, and that's what in the live cattle market, that's what hurts everything. Is the feeders really take a beating to some extent versus the rest of the market. December hogs 70.47 up 447. February hogs 73.50 up 308.
And that is Darrell Holaday, Country Futures, Frankfort, Kansas. Do remember, trading futures and options involve risk of loss, may not be suitable for all investors. Do consider these risks before investing. You can talk with Darrell at 1-800-292-4038. You're listening to the Rural Radio Network.